Hey everybody, Brian here from quantlabs.net. Just wanted to go over with you regarding these Quantopian news stories over the last week or so. Quantopian CIO departs as crowdsourced hedge fund. Performance disappoints. It's on FT, Financial Times, as well as on Value Walk, another headline. Quantopian test backfires or just too early to make a determination. Okay, so the big news coming out of November 7th, 2017 is that once the crowdsourced Quantopian went full hedge fund, backed by Steve Cohen. I don't know what the deal is, but he gave 50, was it after the nascent $50 million fund, it manages turn in disappointing results. I'm sure if somebody was in a bank or in a real hedge fund, they'd be fired on the spot for this kind of performance. I mean, this is not chump change that they're managing here. So this guy, Jonathan Larkin, parted ways with the company, and he was in charge, I believe, of all the algorithms. He said, this is the founder, John Fawcett, said that the journey to creating something great is never easy when pursuing an audacious goal in public view. That's true. So what Quantopian is a freelance computer programmer, data scientist, and mathematician who want to dabble with coding, automated trading algorithms, and licenses the best ones for its own funds. But there's another article in the Value Walk we'll go over on this concept. They didn't give a reason why the guy left. Now, he was supposed to be some legendary guy that they managed to get. He didn't last very long, I guess. So people familiar with the matter said it was partly due to the disappointing performance of the fund since it started earlier this year, which was down 3%. Now, we did another article about a year ago on the return was like 1%, which was nowhere close to what the benchmark of the S&P was at. And remember, these guys focus only pretty well, I believe, on U.S. equity. So, with this year being a really good year for S&P 500, these guys should have done really well as well. But again, we'll address that in the next article. Mr. Cohen, who runs Point72, is family office, and the also are Andreessen Horowitz, a venture capitalist, has backed them as well. So they have 160,000 do-it-yourself programmers on its platform. To turn work into viable trading strategies has proven tricky. Now, again, we'll address this in the next article, but these DIY programmers, there's 160,000 of them. So you think at least a small percentage of them would be able to generate really good returns for Quantopian. But the problem is, as far as I know, if you do get picked, you're only going to get 10% of the take of which is really your intellectual property using Quantopian's infrastructure. The fund named 1337 after a geeky alternative alphabet on the internet. So they're going to hire interim basis for other members of the investment team. All have been active from the fund's inception in its daily management. So this is a crowdsourced fund now. They got rid of, I believe, the live trading a few months ago. That's why Quant Connect is pretty well taken off in the last few months, because people were like ticked off that they can no longer live trade through Quantopian, which was its really original inception. So what I've noticed here that they've got QuantCon, which is fairly interesting. Their convention, I guess, or conference in New York, and they have another one now coming up in Singapore, which is kind of cool. Apparently, I've heard. For a couple $100, you can get access to some of these good talks, and with all their. So now here in Toronto, what I've noticed is that they're showcasing basically educational web. What do you call them? Seminars on how to use the platform. You pay a couple $100, I think $200-300 here in Toronto to use this. So that might be another revenue stream that they're trying to use. and it's an all-day seminar. So here in this Value Walk article, again, Quantopian tests backfires are just too early to make a determination. Now, we've already shown that the return has been -3. A year ago, it was just barely 1% from what I remember reading. So here, that's already a year, pushing 2 years. So I give this so-called fund, crowdsourced, about another quarter to really prove themselves, and they have to have a stellar quarter to really build up their credibility. I mean, they may be able to perform, but and come out of the middle of nowhere in the next year or two to really outperform the markets. But they're going to have a lot of credibility problems on their hands as they stumble. So hopefully they can get it back into a better positive and get some alpha over the benchmarks like the S&P 500. But this article, Value Walk, is very valid, and I'm not going to try to explain why I think the Quantopian, the idea just doesn't work. But let's go through this because I think this better explains what I've always thought. So I'm going to let this guy, Mark Mellon, at Value Walk, describe the problem. So as I said, the guy in charge of the investment officer put together the algorithmic strategy, Jonathan Larkin, has left the firm. So now they've got all these questions and answers based upon these assumptions on what's going on. So recruiting without an understanding of how markets operate on a beta level leads to quantitative failure. And right there, that is very true, because you got a guy like Steve Cohen who probably likes the idea of putting money into an alternative fund like this. But there's no lack of talent, because that's what Steve Cohen talks about. And I was just listening to what sounded like a very institutional level of guys from a company called Estimize, and they said the same thing. And it was very fascinating where things are at. And Quantopian did come up, but there was no commentary on it. So this poor initial platform performance, what could have gone wrong? So the real problem is that a lot of these people that come into writing these algorithms just don't understand how the real markets flow. I've been doing this for 8 years, and I've been figuring out that people are looking for their quick, rich schemes to make money in the markets, but they don't understand how the markets flow. It's taken me a very long time to get to that point, and a lot of it was just due to reading the Bloomberg News app every day and consuming it. I've kind of slowed down because I want to focus more on my current strategy right now for Forex. But yeah, I think it's an essential way to really understand how the markets work, and doing that every day helps. And that's what I tell people every time they come in, what's the best way. And if you're not willing to put the energy into learning Bloomberg News app, you will get smoked out. And proof right here of Quantopian is a great example of that, because as it says here, this quote: recruiting and training mechanical engineers, nuclear scientists, and other amateurs, let me underline amateurs, around the globe to be quantitative traders may be more difficult than some had expected. Don't know who quoted this. They have 160,000 users writing more than 600,000 trading algorithms. That is crazy. They have a strong technical knowledge, no doubt. They had a bold vision to create a platform of tools and applications, which is done really well. And they're the trailblazers in that, no doubt. That allow computer programmers to test their algorithms in a low-cost environment. Now, what I've noticed over the years with Quantopian is what's happening. You get these lazy guys come in and just basically clone algorithms, the better performing algorithms, and that is not going to make the first original algorithm very efficient, because as they call it, from the terminology that they explained on the podcast is that you got too many people fishing in the same pond. So if you allow the cloning, that's what happens, and that's what's happened here, obviously. These people built tools widely considered significant advancement, creating shortcuts and access to data that were previously roadblocks to widespread quantitative adoption, which is true. The firm selected what it considered best algorithms on a backtest, placing them in diversified blended portfolio. So what could have gone wrong? So again, here ValueWalk questions the Quantopian platform that went unanswered. So Quantopian was approached by ValueWalk in an effort to determine the problem where things might have occurred. After initially agreeing, Quantopian declined to respond after receiving the questions. Now that's pretty well very bad, because Quantopian should be, if they're crowdsourced, they'd be able to be open about their performance and where and why they failed. But if they're not answering these questions, then that right there I put in a suspect, because that means they have either something to hide or they're not confident with where things are at for Quantopian, which means the industry probably will give them another quarter to really get it together. Otherwise, just write it off and not really keep Quantopian perceived in the mainstream, especially when you got 600,000 algorithms and you got 160,000 users, and you're still returning negative returns in a up market for the S&P being at something like 15 or 16% up this year. Crazy. So here are the questions that, 4 questions that Quantopian were approached by. How are the algos organized and categorized? So this is what I believe that ValueWalk assessed. So the first fundamental mistake was computer programs and mathematicians can easily make is in organizing and categorizing algorithms. At times, this is down to conjunction with fundamental market understanding, which is provided at the top, overlay to markets. The key to developing blended portfolios. So the first round of math of individual, but rather in blended strategy, develop or common the lack of such clearly defined portfolio management plan. So the lack of such a clearly defined portfolio management plan. Well, a few short months of performance is not sufficient to categorize the validity of overall approach. Oftentimes, multi-strategy portfolio managers who do not have a clear and understandable process for strategy diversification are also those that do not operate during a variety of primary beta market environments. There's some other stuff here. The algorithm should be correlated with a market environment, and each formula should have a justification as to why the statistical anomaly works and when or under what circumstances this formula might find an expiration date. If a fundamental portfolio cannot understand the logic behind the formula, this should be given negative attribution in a scoring method. So this is where they failed, it sounds like. Strategy to diversify should include categorization or of algorithms. It should not be at an introductory level exceed 1 page and should be understood by traditional portfolio managers. The algorithms should be correlated. So it sounds like their tear sheets were too long. I don't know. How many different algorithms are used in a portfolio? Organization of the algos allocation toward macro market environment events that have an economic justice and should receive allocation percentages. This is so true. I mean, I've spent a lot of time on portfolio management, construction, based upon the type of events or other factors that will drive your performance in your portfolio. I mean, this is not hard to figure out. Too often, a high number of algos lead to double covering the same beta or repeating market event. This creates a correlation imbalance, and thus, during market environments, the algo don't generate positive returns. So they're muddling all these different, sounds like they're muddling all these different algos in different portfolio categories that basically cannibalize each other, that disable it from getting positive returns. Too often this can be seen in an algo overweight to a market environment of price persistence, which is primarily used in trend following. The third question, is there a concise allocation exposure strategy? The best algo exposure strategies I've seen typically are no longer than one page. Do certain algos receive a higher weight than other algos? Is the exposure time-based on beta market environment analysis or any other macro weighting system? So I think what's being asked here, are you running algos at the best time at what the market tells you to run? And it sounds like they're just blanket running all these algos all the time without considering that certain algos will perform better under certain market conditions, whereas it sounds like they're running them all the time. The key to all multi-strategy programs to overall allocation. Oddly, evaluating the math of each individual strategy might be not as important as first filtering the understanding through the beta found in the predominant market environment. What is the reason given for underperformance? Did the backtesting law not live up to live results? Okay, so I talk to a lot of people on the inside, professionals who are, we'll just say 7-8 digit figures. A lot of them don't believe in backtesting. I've done my own form of backtesting, and I find it very difficult to set up pricing conditions in your algo for certain market conditions. So I just say, you know what? It's better just to let the algo run in a demo mode, which I'm about to do. Doesn't mean I'm right or wrong on it, but the backtesting seems to be tough to do. So here we go. The answer was backfill bias is a subtle killer. If a strategy testing is done, but many primary, secondary market environments were stress tested. Now, I've always talked about stress tested of actual other market participants. That's what you need to test for. So clearly, Quantopian may not be doing this. Secondary market environments were stressed outside of actual performance history. I don't think that was done. If that was the case, they shouldn't be getting negative returns. Was individual validation of a strategy done during a crisis? So here's the summary of the whole thing from this article. It's too early to call it quits on Quantopian vision or success. 4 months performance history is statistically in for a fund with an average time horizon that includes midterm and long-term focused algos. Regardless of the outcome, here's the kicker. Regardless, Quantopian has achieved significant success of building a user base and democratizing quantitative investment methods. So, I don't know if 4 months is enough, maybe another quarter, but they have been testing this for over a year, and I don't know. I've already stated my thoughts, but let me know what you think, and we shall talk to you later.